HMRC collected an extra £48 billion last year from compliance, and most of it was from small business owners like you. Now here is the part that most business owners don't know. HMRC aren't waiting for you to make a mistake. They're actively, systematically targeting the small business sector right now. They've got more staff, they've got better technology, and they've got more data than at any point in history. And the question that I want to ask you in this video is pretty simple. Is it you that they're targeting? Are you on HMRC's radar right now? And if you are, what do you do about it before that letter lands? Because let me tell you, with HMRC, absolutely everything is easier to deal with before they come to you. And I want you to stick with me through the whole of the video, because I'm hoping the video is going to save you significant time, money and stress. And at the end of it, I'm going to show you where to get proper help if you need it. Okay? So question you're probably asking is, why are small business owners the target right now? Well, let me give you the full picture. Because I think when you understand the scale of what HMRC has got to deal with right now, it will change how you run your business. Now, the data that HMRC has published has shown that small businesses now account for 60% of the entire UK tax gap. So that's £28 billion of uncollected tax debt sitting in small businesses every single year. People complain about large corporations. Well, less than 13% of the tax debt is with the big companies. Wealthy individuals, those multi-millionaires, there's only about 11% of the tax gap there. It's small businesses who are the biggest source of uncollected tax in the UK. And HMRC knows it. And that is why you're the biggest target right now. Now, in November 2024, the government deployed a lot more enforcement agents, a lot more compliance officers, and they're specifically focusing on businesses and individuals, and they've announced plans to bring a heck of a lot more tax officials on the job to be doing more of this. They've invested heavily in AI and the data technology that makes enforcement faster and more accurate. And the centerpiece of all of this is a system called Connect. Now, Connect is HMRC's AI-powered intelligence engine, and it holds over 55 billion items of data on UK taxpayers like you. It cross-references your tax returns, checks it against your bank account, company's house filings, VAT submissions, land registry searches, online platforms, and even what you're posting on your Instagram. Now, in 2024 to 2025, that tax year, Connect on its own helped HMRC recover an additional £4.6 billion in tax, and that is up 35% on the year before. Now, this system has enabled 540,000 individual investigation cases in a single year. Now, what Connect does is simple in principle. It looks at what you've reported to HMRC, and then it looks at everything else it knows about you. And if those two pictures don't match, it's going to flag you. Your declared income versus your apparent lifestyle. Your turnover versus your VAT returns. Your salary versus your dividends. Your expenses versus your industry norms. And here is what makes it particularly important. You don't have to be doing anything dodgy to get flagged. Connect produces false positives. It flags patterns that have got a perfectly legitimate explanation, which is why so many honest directors end up in an HMRC inquiry, and they never saw it coming. Now, I am seeing more, I've never seen more HMRC enforcement agents out there now. Like, there's not a day goes by that we've been speaking to a director for a few weeks, a few months, telling them, listen, HMRC aren't going to wait, and then bang, that winding up petition lands on the doorstep. Or somebody's come, an HMRC agent has come and took a control of goods, okay? So today, in 2026, they are out there in force. And I want to tell you why I feel you should be listening to me, right? Because I'm not a guy who's talking to you, preaching from an ivory tower. I went through my company insolvency. Like, I've been where you're at. HMRC was one of the creditors. So I've sat in the position where HMRC is not a government body in the distance. They were very real and they frightened the life out of me. I owed the last VAT return, I owed the last corporation tax, and I was planning on paying them, but the government changed the goalpost. And like, I remember avoiding the phone calls. I remember not opening letters because I had no way of paying it. I didn't know that I could ring the phone up and speak to HMRC. And actually, most HMRC agents are really reasonable people. Terrible. I felt so lost. I didn't know who I could talk to. I remember going to work, and in the day I'd keep myself busy, you know, checking emails, checking phone calls, being positive. And I remember sitting down with my missus and kids at night, or just going to bed, and that's when the problems would start, because I'd start thinking about it, and I knew in the pit of my stomach it was unfinished business. I hadn't dealt with it, okay? And what I learned from that experience was actually is what built this business. I mean, I'm not an insolvency practitioner, but I am the managing director of the #1 director advisory company in the UK today by a country mile. We've got more Trustpilot reviews than anyone, like proper Trustpilot reviews, which are, you know, depth and weight. Go and have a look at them. And what I really understand now about HMRC is how to speak to them and not be afraid of them. Treat them with respect. This is why I make these videos. And the reason my team takes calls every day, we get 500-600 inquiries a month, is because the information I'm about to give you is the information I wish someone had sat me down and given me all those years ago. Because most of the directors I speak to who are in difficulty with HMRC, they're not there because they are dodgy people. They are there because they did not understand how much scrutiny they were under. They made a silly error. They didn't take steps early enough. They were robbing Peter to pay Paul. They didn't pay that next VAT return because they needed to pay this supplier, and they just thought, well, I'm not paying this month's PAYE, I'll sort it out next month, and it's just got out of hand. But a lot of situations are fixable. But you've got to fix it before really HMRC are on your doorstep, or worse still, the open inquiry to you. Now, if you want to understand, by the way, if there's anything I've said so far that's made you think, you know what, I'm going to speak to somebody today, go to the comment section below, put your details in that link at the top, and one of my team will call you today. No strings, no obligation, okay? Now, in a moment, I'm going to walk you through the 7 specific things HMRC is looking for in a small business right now, okay? So this is like a checklist I want you to go through. And I want you to go through each one honestly and ask yourself whether it's an area of vulnerability, okay? Because if you know what they're looking for, you've got more options. So stay with me, right? So let's call them the 7 triggers. There are 7 things HMRC is actively scrutinising in limited companies right now. So work through each one and be honest with yourself. Now, trigger 1 is your salary and dividend structure. The model of paying yourself a low salary and taking the majority of your income through dividends is absolutely legal and widely used. In fact, for most directors, it's the most tax efficient way of taking money out of the company. And HMRC knows this. They also know that directors sometimes push this structure beyond what the company profits can actually support, right? So if you are taking dividends out of a company that's not making a profit, that's a problem. Okay? And what the Connect system is looking at is a mismatch. Dividends where they're being paid when there are not enough profits to clear those dividends. So you might have dividends levels that swing wildly year on year without a clear reason. Okay? Also, I need you to be mindful of this. If you're taking dividends out of that company that the company cannot afford to pay, and you end up in an insolvency scenario, you're going to be asked to pay them back. And that's a big problem for directors. Now, from the year 25 to 26, the tax year, HMRC introduced some new reporting requirements for directors of small limited companies like you. and it covers most small limited companies. Now, a director must report the company name, registration number, percentage shareholding, and their personal on their personal self-assessment return. And it's deliberate. HMRC is building a much more detailed picture of how money flows between companies and the directors, okay? Trigger 2, your director's loan account. Now, I've covered this in hundreds of videos on my channel, but the link is in the description. There'll be a link in the description. But it belongs here because it's one of the most consistent triggers for scrutiny of a limited company director. If your director's loan account is overdrawn and that balance is being allowed to grow year on year without the proper documentation, without properly declaring dividends or salary to support it, you have a vulnerability that Connect will know about. Now, HMRC are looking for large and irregular drawings that don't correspond to declared salaries, okay? Now, a DLA being used as an informal personal bank account rather than a properly managed financial record is a problem. And if your director's loan account is not clean and reconciled right now, this is a moment to address it, not when HMRC asks about it. Trigger 3, okay? Inconsistent or unusual expenses. So, your expense claims will be cross-referenced against your sector's norms. So if you're claiming at a level significantly higher than comparable businesses, Connect will flag that. You might be a one-man band that's got massive entertainment expenses, massive travel expenses. I think the most common area of focus is probably motor expenses, actually, where the business uses, your business use of a vehicle doesn't look right compared to everything else, okay? You've got to remember, you've got entertainment expenses through the roof. Equipment you've bought for the business looks like personal use rather than commercial. Now, the test is not whether you can justify the claims in your head, because a lot of us will do that. Oh, right, well, I can put that meal out here and put that hotel out there. The test is whether you've got the documentation to justify it to HMRC if they ask about it. Mileage logs, receipts, a clear record of the business purpose for every claim. And if the documentation doesn't exist, the claim's vulnerable. Trigger 4, VAT inconsistencies. VAT is one of the most heavily scrutinised areas for small businesses, and Connect cross-references your VAT returns against the returns your suppliers and customers file independently. So if your figures don't reconcile with theirs, it's a major flag. If you are late putting VAT returns in, or you miss VAT returns altogether, that's a major flag on its own. Unusually high repayment claims is going to be another thing. So if you're putting, sudden changes in your relationship between your turnover and your VAT liability, or your business is operating below the registration threshold, but your transactional data in the bank shows that you should have registered a long time ago. Now, if you've got any uncertainty about how your VAT has been handled, or if you are approaching the registration threshold and you're unsure where you stand, get advice of your accountant. Because the cost of a VAT problem found by HMRC is going to be a lot higher than the cost of getting it sorted first, okay? Trigger 5, cash-based and high scrutiny industries. So certain sectors are under permanent attention. Construction, hospitality, retail, tradespeople. Any business that is handling significant amounts of cash transactions. And if you operate in one of those sectors, the bar for your record keeping is going to be higher. And it's been not because you assume to be dishonest, but these industries generate data patterns that are harder to verify. And that means the algorithm is collaborated to look more carefully at them. So, let's say you're a builder, or you're in construction. You've got your CIS returns and your VAT submissions. They've got to be consistent, okay? If you're in hospitality or retail, your cash handling records need to be rigorous. And if you're a tradesman taking cash payments, those payments need to be declared. Because HMRC today in 2026 has got a lot more data about what your lifestyle suggests you earn compared to what you think that they know about you. Now, trigger 6, and this is so avoidable, late or missed filings. I mean, if you are late submitting a return, it's a signal to HMRC that A, your administration's not in order. I mean, one late return might not be unremarkable, if you will. But a pattern of late returns, your corporation tax is always late, your VAT, your self-assessment, your PAYE, it basically builds a risk profile that moves you higher up the queue for a check. So, listen, it's dead simple, isn't it? File on time, every time. It's one of the lowest cost, highest impact things you can do to reduce your risk. Now, trigger number 7. And this is surprised so many people on social media. You know, I've seen loads of posts on LinkedIn and Instagram. It's your lifestyle indicators. Connect not only looks at the tax returns, it's looking at property purchases. It's looking at land registry. What vehicles are registered to your connected parties? Have you got any holiday lets, any Airbnb listings? Have you got any overseas financial data through, because they can now get information from international areas through data sharing agreements. You know, are you constantly posting on Instagram, the Rolexes, the Lambos? Because if your lifestyle doesn't match your declared income, that'll be noticed. And it's not a reason you need to be paranoid, but it's a reason to make sure that everything which funds your lifestyle is properly declared and documented. Rental income, investment returns, income from a side business you've got, consultancy work, all of it needs to be on your self-assessment, You can't be hiding anything. So, what should you do right now? You've probably gone through those 7 triggers. Now, if any of those ring a bell, here's what you need to do. And the most important thing is to act now before HMRC does. HMRC operates a sliding scale of penalties for a careless error that you disclose this yourself before that they actually find it. The penalty might be nothing. The same error discovered for a compliance check will cost you significantly more. And an error deemed deliberate carries penalties of up to 100% of the tax owed, on top of the tax itself and on top of the interest. Now, the gap between coming forward voluntarily and being caught is enormous, and that gap closes the moment HMRC opens an inquiry. Now, if you're watching this and you know that you've got errors or inconsistencies, okay, and you know that they're not going to stand up to scrutiny, the best single decision you can make today is to speak to somebody who can help you, okay? It's not a weakness. It's exactly what the penalty system is designed to encourage. Now, practically, here is what a compliance-ready business looks like. Your director's loan account's reconciled, okay? And it's supported by proper board minutes, okay? Payroll records. Your salary and dividend structure is backed by paperwork showing dividends were lawfully declared and you've got sufficient profits in the company to do the dividend. All your expenses are documented, okay? Mileage logs, receipts, clear rationale for every claim. Your VAT returns are consistent. Your sales, your purchase records, and they're filed on time. And you retain your records for a minimum of 6 years. And if you've got an accountant who does more than file returns, sort of someone who understands your business and identifies your risk before it becomes a problem, they are a godsend. And seriously, consider tax investigation insurance, because defending a claim can cost tens of thousands of pounds, whereas getting insurance from your accountant might be a few hundred quid. Now, here is the thing about the moment we're in right now. HMRC are not the bad guys. They've just got more resources. They've got more data. There's more political pressure to close the tax gap. And that's a good thing. Listen, the country needs the money. But the Chancellor has publicly identified a £47 billion tax gap, and they have said, we're going to close that. And all this investment in compliance means one thing. They're coming at you. So the window between getting your affairs in order and HMRC coming up looking at them, it's narrowing it. And it's not, in a lot of cases, because you've intentionally done something wrong. But the system is getting better at finding things, including things that have innocent explanations. Now I see this every week. Directors knew they meant to sort it out, they left this 6 months, and then the letter arrives. The directors who come through this well are not the ones who got lucky, they're the ones who got ahead of it, okay? Now, if you found this video useful, and you might be behind with HMRC, you might owe them VAT, PAYE, corporation tax, I want you to go over there, and I want you to watch the video on how to set up a time to pay arrangement, okay? It'll tell you what to do, what not to do, how to speak to HMRC, and at the end of it, you'll be able to pick the phone up and try and deal with this problem head on. Thanks for your time.